Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora, welcome back to the podcast. Can you believe this is episode number 50?
Crazy.
So crazy. And we thought, okay, we better get a good guest on today. We've got Hamish Wilkinson, aka Wilkie, on the podcast. I'm sure you feel very honoured to be our special guest on episode number 50. There is also another reason we brought Wilkie on. We did just collab with Financial Markets to do our quarterly FX Tactical, where we sort of look over all our, key Kiwi currency pairs and put out a little outlook on them. So we're going to be running through, what the Kiwi US, Kiwi Aussie, Kiwi Yen, all of those, the usual that we cover with our new outlook. But first of all, I think it's probably worth talking about, what's changed in the last quarter since the last time we did an FX Tactical. I know looking back, it's actually kind of refreshing now. We're kind of back to seeing currencies move more predictably with interest rate differentials as opposed to all the headlines that were driving currencies last time, right, Wilkie?
Mm-hmm.
Yeah, thanks for having me, guys. MJ, Sabrina, 50th, I'm on it. Yeah, you're correct. If we go back to, even perhaps when the last time I was on the podcast back in December last year, we've obviously gone through a massive period of geopolitical instability, and now obviously we're post sort of that the noise from tariffs feeding through markets, etc. And certainly markets are definitely focused in on interest rate differentials as kind of the key driver back in currency world. I guess the last quarter, probably on a reflection, if you look at it, maybe you could actually break the quarter down into thirds. Really, sort of the first 2/3 of the quarter was relatively benign from a Kiwi perspective, but certainly in the last month or so, things have sort of enlightened again, and obviously with the outcomes with regards to the Reserve Bank's recent monetary policy decision, and then subsequent GDP number really sort of has got the Kiwi under pressure again.
Yeah. I mean, do you think de-dollarization is still a theme just kind of in the background that, we're kind of seeing, because the tariff is still a situation, and there's still, I think, the DXY is down 10% from the start of the year. So I think maybe that's still a factor just, behind the scenes.
I mean, certainly, I think there's obviously this, globally, there's investors still have concern around obviously where the Trump administration is going to drive things over the next few years, and so there will be that concern. But equally on the other sort of side of the scale, you look at sort of, I guess, US equity markets, they continue to outperform and seem to carry on to new highs after highs. So it will, I guess, always be in the background. But for now, it just certainly feels like we're sort of going back to the traditional drivers of what drives currencies. Yeah. And obviously, we're looking forward in terms of the US dollar over the next, the Fed rather, over the next few months and into next year will probably be quite a big focus in terms of as they ease interest rates.
Yeah. I think one thing that's been really key over the last month in the quarter is just seeing the Reserve Bank really pivot in its direction and signalling, more rate relief, because up until August, there were still debates about whether we were going to get a sub 3% cash rate. We were here, banging on the table for 2.5%. They did pivot quite significantly in August. That kind of sent the Kiwi lower. And then again, that GDP number that we talked about in last week's episode, that's also, really reaffirmed the need to actually go below 2.5% to 2.25, potentially 2%. And that's really what's been weighing on the Kiwi dollar across really all the crosses, most of them, right?
Yeah, I guess, firstly, congratulations to you guys for sticking with that. Obviously, initially that 250 call, and then now obviously moving to 225. And markets were holding in a holding pattern prior to that. Certainly, or currency markets were in a holding pattern prior to that, rather. But now, I guess with the opening of the door of a 225 OCR, particularly in the cross currencies, well, not so much in the Kiwi. As I said earlier, if you look at sort of the Kiwi dollar per se is given those sort of those factors of expected Fed easing, along with obviously the renewed downward direction in short-term interest rates domestically, that's held Kiwi dollar broadly within the range that we've seen over the last quarter. Hasn't really broken out of major key levels as of yet to the downside, but certainly in the cross currencies we've obviously seen some action there and some key levels broken.
Yeah.
But the Kiwi US has broken below 58 today as well.
It has, it has. But I think we're sort of looking out, and we point out in the tactical, which is, I've obviously got hot in my hands here now, we've pointed out in the tactical from a Kiwi dollar perspective. We're looking sort of around sort of the 57.28, 57.30 is kind of a key major support level for it to breach before potentially opening up towards 55. We don't think 55 is necessary on cards. Well, it may be on the cards in terms of as a level, but breaching that level, given now we're moving into a world where the Fed is, likely to is more than likely to cut interest rates 50 basis points by Christmas, and then they're scheduled for another 25 basis points at this point for 2026. You got to factor in terms of what obviously we're looking at from a new Fed chair, particularly with the current Trump administration. They've made it clear that they obviously want lower interest rates, and so wouldn't be too surprised to see a dovish Fed governor appear in 2026.
So basically you're saying how that Kiwi will, trade, or there's downside risk to that Kiwi dollar, but it's kind of capped because you've got the Fed starting to come back in, because they cut for the first time in September this year and they're signaling another 50 basis points. What's market pricing now? Yeah,
so market pricing has the Fed for all of next year, it's around about until middle of next year, I recall, around 100 basis points price. So if we look at where the dot plots sort of indicated 50 this year and then 25 next year, so market price is slightly over kind of what the Fed has suggested. But yeah, as I said, proof will be in the pudding, and once we start to see, I guess, that new Fed announcement and what and how the in terms of the Fed makeup will develop in 2026. So hence, just providing, I guess, a little bit of support to just that one-way direction downside of the Kiwi because of obviously what we've seen domestically. And I guess I would also point out, OCR, the terminal OCR or OIS pricing now sort of has terminal rate sitting around the 226 region, I think it was. So so that's quite well factored in. And I know there has been discussion of the need to go to 2%. Until we see that sort of come through, then obviously that will be a factor in providing some support, particularly if we see any upside surprises in domestic data, which hopefully at some point, this lower rates environment does bring some good news to us. So,
And I guess if we're talking about next year, the Fed could continue cutting, but hopefully we're on that type of the start of the cycle where we're starting to see a bit of growth, and so that should provide some upward support to the Kiwi.
Hang on.
Yeah, so, okay, but you're saying against the Aussie dollar, though, there's been a bit more of a movement. I think for the last, this whole year, really, we've just been saying how that cross has just been very range-bound, very stuck in that what's the range, like around the 90 cents mark, and kind of just oscillating around that. But it has really broken below 89 cents, right?
89.5. So, we've called out 89.5 as quite a big level for some time now, multi-year support level. I think it'd been there 3 or 4 times and bounced back off that level. So from a technical perspective, if you're a chartist, really, really big level. So, and then finally it gave way on the back of the GDP number. It was eventually broken through, and obviously we've seen it accelerate lower as a result of that. So, in the tactical, some of it, we'll put some charts in there for people to have a look at. But certainly, I guess with the RBA, they have an announcement tomorrow, so probably the podcast will probably be released by that time. Not expecting any change there. But realistically, sort of the RBA is relatively in a good setting. Markets still anticipate another rate cut at some stage. Only one rate cut of 25 basis points, but realistically, sort of from an interest rate differential, as we sort of pointed out at the top of the podcast, that's really kind of the key element that's driving Kiwi Aussie now looking like a potential opportunity down towards the 87 cents mark from a trend and a technical perspective.
Yeah, absolutely. I guess if you look at, Aussie rates all across the curve, they're higher than Kiwi rates. So that interest rate differential is really having a significant effect. And like you said, there is one more cut penciled in for the RBA, but that's actually even been pushed out even further. Originally, I think when we wrote the tactical, it was looking like it would be sometime before the end of the year. Now that's been pushed out, just with hotter than expected Aussie inflation. And, you know, the RBA has been more cautious, and mainly because their economy can allow it. You know, the performance of their economy has sort of allowed that cautious approach, whereas in New Zealand it's a very straighter bet of play. You know, the Reserve Bank path forward from here is very clear towards that lower trajectory. So yeah, what is it, like a 3-year testing 3-year lows? We're past 3-year lows for the Kiwi Aussie
Yeah,
now.
2022 is the 87 low, so we're not quite. Yeah, we're pretty close to 3-year lows. That's the target really, if on the downside for particularly Aussie dollar sellers. So that's really where the focus will be. And again, it will just be sort of understanding whether or not that rate differential could potentially widen out from a spread basis, to see whether any further losses are potential there. But yeah, certainly if you look at Kiwi Aussie over the last number of years, you know, predominantly it's sort of traded between 90 and up towards 1. But yeah, obviously now we've moved back in towards the bottom end of that broader range, that's for sure. So, yeah.
We did hit 1. We did hit parity.
Yep, I think we did for like a brief second, I think it was.
For a brief second, like one morning.
Yep.
On a technical level, though, you were saying that the Kiwi Aussie RSI might be a bit oversold. Right?
Yeah. So I guess, you know, all markets move, you know, from a momentum perspective, and particularly a lot of traders will look at whether a move has overextended for a period. So, you know, in our latest tactical, we sort of highlighted a couple of key currencies that potentially from a momentum perspective have gone too far and, you know, can have a pullback. That could be just a movement sideways, if anything, and then their RSI will start to improve or correct itself, and then that doesn't necessarily mean a change in trend per se. It's just more about whether or not sort of it can continue to weaken on a continued basis.
Okay, moving on to the next one, Kiwi Euro. It's a really fun one. You know, I really like the chart we used for this one because it goes back to 25 years. And like Sabrina, you were probably what?
0.
And then I was probably like 6. And it's just to see.
I was a little bit older.
Yeah. Just to see that cross getting really close. I think it's down to the lowest since 2009. Do you think we could get down to 30, what was it, under 40 cents against the euro? That was low in the GFC.
It's another one that's extended quite, you know, in terms of from an RSI perspective, is fairly quite overextended. Potentially, you know, the ECB have now moved probably more to a neutral setting. The cash rate at 2.25, and realistically, kind of just keeping a watchful eye on inflation. So I guess in that respect, the fact that it's, you know, interest rates have settled in Europe for now, and obviously we're still in this, you know, potential move to ourselves. You kind of sort of, it does gives you the justification and understanding why Kiwi Euro has been under the pump, probably one of the more broader, you know, one of the other main currencies that we do some analysis on, that it has been heading that way. Technically, yeah, if it does sort of go through this 49.5 area, then it's blue sky into sort of GFC lows. So, yes, in short,
I think I think it's cracking like 49.40 now.
Yeah, well, yeah. I mean, it's a line on a chart and it goes back on a very long time.
Yeah.
So, yeah, I mean, potentially we can move into sort of a broader new or significantly new range in that respect. But again, as I said earlier, sort of any sort of upside surprise in Kiwi data, you know, that will provide support to some of these under the pump currencies that we'll obviously be discussing as well. So just mindful of that. And so, again, just for people that are importers, exporters that are, I guess, considering these sorts of levels, it's something to just be mindful of, that there's a lot of bad news baked into New Zealand economy right now. So, yeah.
So what I'm hearing right now is that it's not a good time to go on holiday.
Yeah, unless you're probably going to Japan, perhaps.
Okay. So let's talk about
let's go
Japan. Yeah, well, that's been quite a volatile cross, you know, in terms of the pressures there. I mean, obviously we've had a broader downside Kiwi yen view based on interest rate differentials again, Bank of Japan tightening, and obviously, what we've gone from, our post-COVID high of 5.5% down to where we are now. And so, arguably that Kiwi yen should be lower. And it has traded lower, obviously did trade, last quarter, the previous quarter to where we are now, obviously down just to below 80 yen per dollar. But over the last quarter, obviously it's the Kiwis actually have found a little bit of support versus the yen, really sort of driven not really on interest rate differentials, and perhaps can sort of talk about also the Bank of England somewhat here as well, is just in terms of nervousness around
The Bank of what?
Bank of England here as well.
Oh, England.
So they sort of come into the same sort of drivers per se. But yeah, in terms of just nervousness around Japanese debt issuance, and ultimately sort of whether or not the Bank of Japan can continue to tighten policy as much as probably they would like to, without causing issues to longer term interest rate yields.
There's speculation that the BOJ will intervene again, and
correct. Try and fight that financial stability as well. And long dated yields.
Yeah. Okay, so the slight upside to the Kiwi yen cross then.
A broad range really, I guess. We've sort of talked about a 80 to 90 cent range per se. So it's just continued volatility. We also put in our charts as well, sort of again another technical picture of what we define as a head and shoulders pattern, and arguably there is a little bit of upside, surprisingly enough, even in this current environment for the Kiwi to outperform from a technical perspective, but that can also be blown apart by I guess a renewed interest rate expectation or drivers towards 2% if we see that here domestically.
Okay, moving back to Europe and going to the UK, the Bank of England, there some interesting things happening over there because they're starting to see a bit more persistence in inflation. It's proving quite sticky and quite high, and it's hard for them to bring it down. So they've had to keep interest rates on hold, but also they're doing some interesting things on their balance sheet. I think they're one of the central banks that are actually selling down the government bonds that they bought over the COVID period. That's adding a bit of easing to the mix as well. But they've had some issues with their gilt market for a long time now. How's that playing out in currencies?
Yeah, and you bang on in terms of sort of you've got a Bank of England rate at 4%. We've got the RBNZ cash rate heading to 2.5, 2.25. From an argument perspective, and we have talked about it for over a number of tacticals, as Kiwi sterling is lower, but over this last quarter, those moves have sort of held up a little bit, and again, similar to the discussion we had regarding Bank of Japan and nervousness around longer term interest rate dynamics, particularly from a UK perspective in their gilt market. That's had a weakening effect on the pound. I guess investors are concerned about the security of those particular those holdings as such, and so we've just seen those movements, that broad Kiwi weakness versus the pound, just hold up over the last quarter. And we started to sort of trade almost into a semi sort of triangle direction. Key support sort of from Kiwi sterling sort of is around the 43 cent mark, around 42.80. I think we sort of mentioned in the tactical. And that will remain keen for now. If we see, again, as we've discussed before, we see any upside surprises in Kiwi, then the level to watch on the upside will be sort of the 44.5. So it's a potentially narrowing triangle, and so it's going to break either way, and that will probably give us broader, longer term directions once we see sort of this break of this current sort of consolidating range.
It's a good wrap up.
Thanks.
Now, you haven't been on... Yeah, take a break.
Yeah, thanks.
You haven't been on the podcast for a while, but I'm sure you remember every time we do one of these episodes when we're talking about Kiwi currency pairs,
yes,
we always like to throw in a bit of a curveball, a little bit of a curly currency that we haven't discussed in the FX Tactical. And so for everyone listening, Wilkie does not know which question we're about to throw at him. So today we're going to talk about the Kiwi Krona, which is Swedish, and we're talking about it because we did hear last week that we've got a new central bank, Reserve Bank Governor, Anna Breman.
Mm-hmm.
Dr. Anna Breman.
Mm.
She comes from the bank of, it's the
Risk Bank.
Rick's Bank.
Yep.
Rick's, yeah. So, yeah, we thought this is an excellent time to ask you about the Kiwi Krona.
Kiwi Stocky, we call it.
Is it?
Yeah, Kiwi Stocky and Kiwi Noki. So for Sweden, it's Stocky, and for Noki, it's Norway. So that's how we would term them in the currency markets.
Oh, okay. I didn't know that.
So what do you want to know about it? How it's
Where's it
performing?
going?
How's it performing and where's it going?
Well, I guess Sweden is, intrinsically tied to Europe. If you look at it going back from back in a number of years or so, even if you look at sort of its interest rate settings, often will tend to follow what's happening in Europe. And so, from last year, Kiwi Stocky traded up above 6.6. I think one Kiwi bought 6.6 Stocky. And now it's traded sitting around about the 5.45 mark off the top of my head this morning. So that's broadly followed the Kiwi euro.
So this is not a curveball?
Yeah, it sounds like you've looked into this. Guys, I promise we did not tell him this question beforehand.
Well, actually, funny you say that. I've actually kind of fielded quite a few questions in terms of our new Reserve Bank or incoming Reserve Bank Governor.
Yeah.
And kind of a number of questions is why we're bringing in someone from the other side of the earth.
Yeah.
And, my response to this, some of these actually were, when you actually look at the Swedish economy and the New Zealand economy, from a data perspective and an economic performance perspective, there was actually a number of similar drivers that actually have affected both economies, and particularly post-COVID world. So I've actually brought some statistics with me, and perhaps it might actually provide some context to the listeners to really provide some understanding of that how the Riksbank dealt with post-COVID inflation to versus the Reserve Bank, and also may explain perhaps some of the rationale of bringing in a Dr Anna Breman as our next governor.
Okay, what are your findings then?
My findings?
Yeah.
So starting at the top, post-COVID inflation. So I'll give you the Swedish number, and you guys can try and remember, obviously, what the New Zealand data is, because you guys
So we have to
are
buzz
the
in.
local economists. Maybe you could do some buzzing. So post-COVID inflation, peak in Sweden, 10.84% in December 22. Can you guys recall
Buzz.
with the Kiwi?
7.3
Yes.
in June 2023. Two.
Very
Yeah.
good. Very good. So obviously they had a higher inflation. There's probably a little bit more inflation driven through
Europe.
through Europe and
Also,
the war.
they're
as well.
closer to that Ukraine crisis.
Yeah, correct.
Yeah.
Today, Swedish inflation sits at, from my information, 3.2 to 3.4%. Kiwi inflation.
MJ, go for it.
Around there.
2.7.
Very good. Very good. So inflation have been brought broadly back into line. Cash rates, peak cash rates. So remembering that Sweden had a long period of negative interest rates like Europe through the teens, and they actually engaged in quantitative easing through that period. But post-COVID, they lifted their cash rates to 4% in Sweden, and we got to...
This is an easy one, 5.5.
Correct. So they obviously had less tightening, I guess, compared to what we saw. As of today, policy rate, actually, the Riksbank actually just dropped their cash rate to 175. And obviously we know where the Reserve Bank is, and we know where the Reserve Bank is going to go.
And the Riksbank has signalled the potential end of the easing cycle too.
Interestingly enough, Swedish GDP, second quarter GDP, 0.5%, and year on year, 1.4%. RBNZ, we've just had the GDP numbers.
Minus 0.9 and minus over the quarter, minus 0.6% over the year.
Yeah, so obviously, in terms of sort of the driver of I guess, central bank policy in terms of the impact on GDP, the Riksbank has probably done a slightly better job than probably what we've seen from the Reserve Bank. So I guess their argument there is that in terms of just the management of a soft landing, the Riksbank have done a pretty good job in obviously bringing inflation down from a higher level, yet not impacting GDP outcomes perhaps as much as we've seen from the Reserve Bank. And as a result, that's probably why Dr. Anna Breman is is probably our new governor of the Reserve Bank.
That, and maybe the fact that she's got a PhD in economics and she's got.
Oh, that's
so
true.
many
I mean, obviously, in terms of her background, definitely is very experienced
Yeah.
and very skilled. But
I mean, I think it's
she's been at the Risk Bank since 2019 and helped navigate the
Yeah,
Swedish
yeah.
economy and monetary policy cycles in a very effective way.
Yeah.
I mean, I also think it's not hard to look at other central banks and see that many other central banks handled the post-COVID situation much better than the Reserve Bank.
I mean, ultimately, I guess we're looking for perhaps the powers that be looking for perhaps a new change and perhaps no ghost in the closet, so to speak. And so it's someone coming from overseas brings that.
Yeah. Well, also the interesting thing is though, she's coming at a time where potentially and hopefully this chapter of rate cuts is over because she doesn't start till December 1.
Yes.
So her first MPS or rate decision will be not till next year, and hopefully we don't have to go to 2%. Hopefully we start to see some those our economy perform nicely over the summer period. That she just comes in, new chapter, different direction for the Reserve Bank. She's emphasized being more transparent and improving their communications, which is something we'd really like to see. So she's ended her time at Riksbank at the end of a cycle. Hopefully she's ending it, starting here at a new cycle as well.
Mm-hmm. That would be great to hear.
Yeah. But, I mean, the similarities in our economies obviously helps for a more smooth transition to coming here.
Very
Great
good.
findings, Wilkie.
Did my research just for you guys.
We love it. Well, thanks again, Wilkie, for coming on. That was really good to go through all the crosses and to see just how things are playing out in the world of currency. It looks like it's very much going back to fundamentals, which is what we like to say because this is the name of the game. We don't want to trade on headlines, but it's good to see that we're kind of going back to fundamentals, and interest rates specifically seem to be a big driver with the Reserve Bank having to deliver a lot more easing than their peers just because our economy is just not performing as strongly. So interesting to see how that'll play through the next time we do our tactical, see if any of these themes have changed. We obviously have a new governor, and that's going to add a bit more excitement to 2026. But I think that's it for this episode. We'll be back with another tactical in a quarter's time. Thank you again for listening. This is our 50th episode. Really appreciate it. Here's to another 50 episodes. Tune in next time.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.